Hi, my name is Bakx-Friesen, and today we're going to be talking about two ways that you can use the equity in your home to invest in real estate. So what is equity? We're going to take a quick example to illustrate what equity is. Let's say that you bought your home for $170,000. Now 8 years later it's worth $200,000. Your mortgage from when you bought it has also come down as you've paid it off over those 8 years. Your value of your house right now is $200,000. Let's say that your mortgage is $140,000, so your equity is the difference, $60,000. So you could take that equity out of your home a few different ways. One would be a home equity line of credit, which is a line of credit that is tied to the value of your home and shows up on title no different than a mortgage does. And that's called, often you'll see it called a HELOC, which is just the initials for it, which is HELOC, home equity line of credit. Another way is just to do a simple refinance. So you bring the value back up of that mortgage, take out that money as cash, and then invest it. So we're going to look at two different ways that you can get that cash, that equity working for you using real estate secured investments. So the first one would be simply to buy a rental home, to purchase a rental investment property. So we can use the equity as the down payment on that second home. If bought correctly, there's a few different ways that you can now make money. The first one is the renter is paying down the mortgage. So just as our first example where we said that your mortgage initially would be an amount that's higher and then it gets paid down to, we use the example of $140,000. This is the same thing, but the renter is now paying down that mortgage for you. The second way to make money would be different when you look at your income every month compared to your expenses. So the amount that you're taking in as rental income, and then you take off your mortgage, your home insurance, your property taxes. If there's some money left at the end, that's cash flow. So every month you can also have some cash flow. The third way would be appreciation. So again, back to our initial example, your house went up over 8 years from $170,000 to $200,000. The same thing can happen with a rental property. So there's a few different ways that you can generate a return on that initial down payment, which was the equity from your house. So the return is always calculated on that initial amount, not on the value of the rental property, the overall value. Second of all, we could also look at doing a private mortgage. So what that is you're taking your money, that equity again, and you're using it to invest in somebody else's home. So you make money on the spread. For example, when you refinanced your home, your interest rate is 2% at the bank. Now you take that money, you invest in somebody else's, and maybe you're investing it at 10%. The difference, which is the spread, that 8% is your return, which is great. A lot of people would be happy with 8%. So the question that naturally comes to mind next is, where do we find these people? Where do we find people who need a second mortgage? So one way that you could find people would be to look at and talk to other investors. So maybe they're doing a project where they're needing a little bit of money to get the project rolling. Maybe they're doing a fix and flip, and that would be another place where they're looking for some money to do some renovations. There's many different ways and different sources of business for private mortgages. Another source of business could be mortgage brokers. So they might be dealing with somebody, as a quick example, who, when they bought the house, they were employed. They've now recently become self-employed, and the bank feels that they're not really ready to give them a refinance, provide them with some extra money, but right now the roof is leaking and they need some money. So maybe they're looking to redo their roof. They'd like to get some new windows, a few other things, and they need maybe $15,000. So that might be another way that you can help out somebody who's in need and also generate a good return. Usually, again, those are second mortgages where you're secured behind the bank as a second mortgage, so you're still on title. The added benefit of private mortgages is that there's no renter. So sometimes people would love to invest in a rental property, but they really don't want to collect rent. They don't want to deal with the hassles. They don't want to run for the leaky tap. So this is another alternative where you still get the benefit of a real estate secured investment, but you don't have the renter hassles. So if you do have some equity in your home and you'd like to talk more about how you can get that equity working for you, give me a call. I'd love to talk to you more about it.